Okay, welcome everybody to Trading Coaches Playbook. My name is Brandon Wendell. I'll go ahead and kick this off, get the video going. There we go. And camera's working good. All right, so welcome. Good afternoon, Brenda. Welcome, Kevin. Good afternoon, everyone. And we'll go ahead and kick this off with a quick reminder that we're not broker-dealers or investment advisors. We're going to look at this information from an educational standpoint. I'm not telling you to buy, sell, or hold anything in particular. Give me personalized recommendations about the markets. I'm not telling you to buy, sell, or hold anything. And markets do involve risk of loss. This is always a situation. No matter what we do, we can never eliminate the risk. We just try to manage it and minimize it. And we are not subject to trading restrictions, so we can have a position in a security or initiate one at any time. Just letting you know about that as well. So welcome, Stephen. And again, welcome everyone to our session for today. We're going to be talking about zero DTE options, which is kind of a popular topic. I've been talking about that quite a bit lately and seeing a lot of the news in the markets as well. We're pretty busy, obviously, with our workshops that we do. I run a bunch of programs for the Wealth Builders HQ, and the main one I'm going to be talking a little bit about today is the SPX Cash Flow Secrets. And if you wanted to learn a little bit more about that program or possibly join me in the program, I would love to have you there. There's actually, let me see, where's my link? There it is. Copy that and paste if I can. Yeah, so I run this program called the SPX Cash Flow Secrets, where we identify high probability opportunities on zero DTE options. So obviously I understand them quite a bit. And like I said, the link is there in the chat. If you're interested in joining me, I'd love to have you there. If you have any questions about the program before joining, you can always email us at support@wealthbuildershq.com. I'll type that in there as well. There you go. So anyway, you can see there's a couple different options here. You can do monthly or quarterly subscriptions, and there's a 2-week free trial, so you can try it out for no cost if you want to on the quarterly subscription. But anyway, getting back into what we're talking about today, zero DTE, what the heck does that mean? Well, 0 days till expiration or expiry, whatever you want to call it, that's what zero DTE. It's basically an option that's being traded on its actual expiration date. That's it. Simple. And you know what? I forgot to log in on a platform real quick. So let me do this. I'll go into my options AI and log in there. It's probably the easiest one I can access at this moment. And, you can trade pretty much, pretty much any option, as it's logging in there, any option becomes zero DTE when it's being traded on its expiration date. So it doesn't matter if the options were being built or being created a week ago, a month ago, or even a year ago. You do have options called leaps. They're long-term anticipatory something. I can't remember what it stands for, but those are available almost a year ahead of when they expire. However, those will become zero DTE if they are traded on the day of expiration. That's it. As a matter of fact, let's see. Go to Trade Station, open that one up. And, basically zero DTE, most of the time when people discuss zero DTE options, they're referring to weeklies. That's kind of the common one that most people are looking at trading when it comes to these. Let's see, update later. And those weekly options are very similar to every other type of option. The only difference would be, hang on. The only difference is going to be the expiration date and when they expire. Oh, thank you, Trip. Long-term equity anticipation securities. I can never remember the last part. It was just securities because they call it LEAP, but it's anticipation, the A and the P. It doesn't make sense, but that's what it is. Anyhow, so that's what LEAPs are. But, getting into this, it doesn't matter what options you're looking at. For instance, if I go back over to my paper account here in Options AI, and let's say we look at the options on the S&P index, when I choose my expiry or expiration date, as soon as it loads up, I'm running quite a few things in the background here, so maybe a little slow. And if I zoom in over here, you can see I've got options that expired today, Monday, Tuesday, Wednesday, Thursday, Friday next week, following Monday, and so on. And I can go out to, only about 300 days on that one. But again, any one of those options will become a 0 DTE at the expiration. If I were to go to a company like Apple, pretty liquid, has a lot of options available. Again, I choose, and you see we have today's expiration, 7 days out, 14, 20. And if I go further out, there we go, a couple of leaps, 2025 in January, 315 days from today. That will become a 0 DTE on January 17th of 2025, if you happen to try to trade that day. So that's all. If I were to look at, this is TradeStation, I was going to bring up Option Station Pro. And once again, you can look at different option chains. It just shows them differently. That's all. The reason why I was bringing that up, just to see the different way you look at it or view it. And again, it doesn't matter if they're weekly options that were created by the CBOE, the Chicago Board Options Exchange, or if they are longer term options also created by the exchange. And again, as this bringing up there, you see weekly, end of month. Sometimes you'll find quarterly. Maybe not here. Let's go to options on the option chain here on Option Station Pro. What do we got? Come on. Got a slow moving computer. Yeah, like I said, I've got too many things open in the background. But now what we can see is, yeah, here it is. We have, as I mentioned, weekly options, and there it is, 0D, 0 days till expiration, expires today. But we also have standard options, or let's see, quarterly options. There's another standard that's not labeled because it's standard. And of course, if I keep going down, look at that. I can go out to 1,000 days from now, and that is December 18th, 2026. That's a leap as well. Anything that's longer than a year, or roughly a year in expiration, until expiration, that's a leap. That's all. But they will become 0 DTEs on the day of expiration, period. So I'm going to close this out to keep my computer running smoothly, and that's fine. So I'll stick with this one for now, which is the trading that I can do on Options AI. So 0 DTE, they have the same characteristics as normal options. The only difference is the time. And most of the time when people are calling out 0 DTE options, they were trying to refer to the weeklies, as I mentioned. And, when we're looking at shorter time frame until expiration on options, there's a couple different things we want to be aware of. And hang on a second, there we go. We want to trade them pretty similar to, oh, you know what? I did need that TradeStation open. Darn it. I realized I need a particular chart I wanted to show you that's kind of interesting, because one of the things that we have to be aware of when it comes to our trading, especially when it comes to options, is that they trade a little bit differently than other securities. When we're trading stocks, we're pretty much worried about the direction of the stock, and we either buy if we think prices are going to go up, we sell if they're going to go down. If we're trading futures, same thing. We buy for upward moves, we sell for downward moves. And when it comes to options, we actually have an extra dimension, and that is definitely time, and volatility is also included in that. So we have what are called the Greeks with options. And it depends on whether or not you're versed in trading options, if you've done this quite a bit or not. But these options, actually, let me see. I was doing a workshop last night. Let's see if I can find those slides, because it has a little bit better description of it. Yes, I had them right here. So while this is still loading, as I said, I'm going to open up this explanation of the Greeks. And we have 5 Greeks. However, for the most part, we're really only concerned with 3 of them to give us an idea of how much risk we're facing when it comes to an options position. And if you don't know the Greeks, you better learn them if you're going to trade options, especially 0 DTE, because it can definitely affect your profitability. We want to have high probability and profitability, meaning we want to make sure we're finding trades that are likely to win on a regular basis. We want to build consistency in trading. And, it doesn't matter if you're trading long-term or short-term. One of the drawbacks of trading short-term, especially with the 0 DTE, is that many traders overtrade. And what we need to do is make sure we're only taking the right trades at the right time, high probability opportunities. So first of all, our first Greek that you hear a lot about is called delta, okay? And delta tells you how much premium will move for the option if the underlying security moves, okay? And delta, D for direction. If we take a look at an options chain, let's see, where's it? Option Station Pro right there. And sorry, I meant to keep that open, not close it up. What I can probably do, though, is close up some of my workspaces so I don't have so many working, tying up the resources. There we go. Close that other one, so I just have one open. There we go. And did it open my Option Station Pro? It did. Good. There it is. So for instance, looking at Option Station Pro, I've got the Greeks being shown here. I happen to be looking at the Qs still. And if we take a look at the 0 DTE options, you'll see the delta, there it is. Right now at the money option, it's usually close to 0.5. Okay, what that means, first of all, delta can be looked at in three different ways. There's three different functions, if you will, for delta. And the first function is, as I mentioned, how much the premium will change for a $1 move in the underlying security. So to keep this from moving around a lot, let me freeze the picture by doing this. Make it a little bit easier. There we go. So now that I've done a screenshot, we are currently trading at $442.27 on the Qs. Okay, so the at the money option, kind of take your pick. It's right around 442, 442 and a half. So we're right in between those two. Well, let's say we're dealing with the 442. Okay, right now the delta on the 442 is 0.55. That means if the price of the NASDAQ, let me change my pen color so we see this better maybe. If the price of the NASDAQ right here changes from 442 and a quarter to 443 and a quarter, the option premium, which right now is at $1.37, that would actually go up by 55 cents. That's all that delta tells us. And if we were to go from 442 and a quarter down to 441, the premium would drop by 55 cents. Okay, so that's the first part of delta. Delta tells you how much prices are going to move based on the underlying securities price movement. It is also, it's not accurate, but it's kind of a shortcut for giving you an idea of what's the probability of that option finishing in the money. Meaning in the calls, the closing price of the security would be above the strikes, or in the puts, the closing price of security would be below the strikes. Okay, so if we have a 0.55 delta, that means we have a 55% chance that by the end of the day, that option will finish in the money, meaning prices would close above 442. Okay, and you can see we can go all the way up here to 447. There's only a 6% chance that prices will be above that area by the end of the day. Now, again, it's not the most accurate, but it's kind of a shortcut that people use. The third thing that delta is used for is a hedge ratio, because you can go to what's called delta neutral, basically balancing out the deltas. I'll show you how that works in a few. So that's the first one. We have delta. We also have time value. And let's see. Have I ever checked to make sure it's being honest? It actually moved 0.55? Yeah, they usually do. However, it's not just price that adjusts. That's what you got to realize. You know, when you're taking a look at these, and let's say we go into analysis. Okay, if I click on that one right here and we go to analyze that option, okay, you can do what are called price slices. So you can actually look to see what is the theoretical profit or loss. So right here, again, we were looking at that 442 call that expires today. However, you can see 442.25. Let me see, can I lock that? Forgot how to do that. Anyway, 442.25, there it is. Shows you the value. And then if I do 443, why did that not go? 0.25. Okay. And again, it'll show what the theoretical value should be based on the price movements. And again, it should have been 55 cents. However, what you got to realize is when the prices move, also the delta moves. And not only that, but volatility is going to move as well. So even though theoretically it should go up by 55 cents, it may go up more or may go up less because it's not one Greek that's influencing you. So yes, in reality, yes, it should only go up by that delta, but there are other influences that are going to change the value. So it's an approximate change, right? And the other ones that we have time decay. When I talk about options, I usually mention that they are wasting assets. They're kind of like an ice cube. You take them out of the fridge, they start melting. And if you ever have a chunk of ice and you looked at it, a big chunk of ice will melt slower than a small chunk of ice or a sliver. So if you have a lot of time left, then you'll have slow time decay. But as you get closer to expiration, time decay grows exponentially. Take a look at the theta. Oops, I was on the right page there. Look at all I got open there. If I go back to the options, again, looking at the theta now, right here, the 442 call has a 154, 151 for the theta. If I go out a little bit in time, let's say we go out about a month, 442, look at the theta there, 17 cents. So we went from a theta right here of $1.50 every single day. That option decays by $1.50. That option's not even worth $1.50 right now. It's only worth 95 cents at this point. Isn't that crazy? So the time decay is greater than the price. And then right here, when you go to 442, we got a $10 option again, but there's only 17 cents of decay. So as soon as you hit that 30-day point, that's where that time decay really starts growing. If we go out much further, look at this. 442, again, well, it's not there, but the 440s have 11 cents of decay. Okay. But as soon as you hit that 30-day point, boom, that's that time decay. They took a flamethrower to the ice cubes. So just imagine on a one-day expiration, that time decay is going to be so great because by the end of the day, you'll have no time left, right? As a matter of fact, most of the time comes out of the option at right around 3 o'clock, 2:30, 3 o'clock in the afternoon. You'll see a big drop in the value of the options typically because, again, the time is expiring. So that's theta. And then we also have vega, and vega is volatility. So when you take a look at volatility, if volatility goes up or down, that will influence the price of the option. Again, if I go back to my analysis page or tab, and let's just focus on one price slice. If we do, you don't necessarily need to sell them before 2:30, but there is a big jump in the price of options at that time generally. It's not exact. It could be earlier, it could be later, but approximately that time is where you see a change. So let's say we're looking at an option that we buy. Again, the 442 call is what I have here, 0 days till expiration. And let's say I bought it and it moved up to, let's do 455.27. Or actually, since we're doing the 442, I'll do 452. Let's say it moved up by 10 bucks today. Huge move in the market, right? Now, if it moves up, delta should give us a profit, right? The value should increase. You can see. If we were paying, what do we have right now for this? For the pay, $132, but if the value would be $1,000, so we made 868 bucks. But if the volatility goes down, and volatility, you don't want to mess that up because volatility is the single biggest impact on options. So let's say the volatility goes down by 10. Let's see, does it show? Come on. Oh, it's not showing this on the slice. Why not? That's disappointing. I thought it would show on the slice because the theoretical profit and loss will be different if the volatility has changed. Yeah, it's not giving me the volatility there, is it? It won't allow me to adjust. But anyway, you could actually lose money even if the prices go in your favor if the volatility adjusts the wrong way. So you'll see the prices changing based on that. And why is this not adjusting? That's really odd. Let me see, 20%? I don't know. Thought I was supposed to adjust there, but maybe I'm doing something wrong. Oh, well, I'll figure it out later, of course. But yeah, basically the volatility is the biggest impact. Now, another thing that happens and is ignored often, by the way, watch this. I can go and instead of charting profit and loss, I can actually chart things like delta. As you can see, I can chart the theta, the time decay. And then right here, another one that's big when it comes to these options is going to be the gamma. And gamma is kind of overlooked a little bit when it comes to trading options, but you got to be careful when it comes to zero DTE options. And the reason why is, first of all, gamma is the rate of change of delta. Okay, because basically delta, remember, changes the premiums. So once again, going back over to our options on the zero DTE options, there's the delta. At 442, we were expecting a change of roughly 50 cents for every $1 move. Notice how that delta dropped to 45, right? Remember, we were looking at 52, 55 earlier. Why did it drop? Price dropped. You know, that old picture that we had, where is it? There it is. As a matter of fact, let me do this. So we can do some comparisons. I don't want to lose that picture. Copy. Paste. There we go. And now, looking at the current value, because it has dropped by about $1, hasn't it? And we'll just focus on the calls. Copy. There's paint. Paste. There it is. Perfect. So remember, when we first looked at this, we were 442 and a quarter. Now we're 441, almost a full dollar drop. And what happened? The option had a delta of 0.55, so we should have expected almost a 50-cent drop in value. How much did we drop? We went from 137 to 94 cents. So it wasn't exact, but it was pretty close, wasn't it? We dropped 43 cents when the value of the option, let's see, went from 442.27. We dropped to 441.44. So we dropped 83 cents. And this is the question that was just asked by Jonathan, you know, is that accurate? Well, if we dropped 83 cents and the delta was 55 cents, we should have dropped by 45, we'll call it 46 cents. All you have to do is multiply the amount that we moved by the delta. And how much did we in fact drop? What was it? 442.27 minus 441. We dropped 83 cents. So we dropped a lot more than we should have. Why? Well, again, volatility might have changed, time changed. There's a whole bunch of other factors that go into that. So we definitely moved more than we probably should have and lost more value than we probably should have. And that's why you got to pay attention to some of those other Greeks. And one of those is gamma, which is not being shown. So I'm going to add that in. Let's see, where's gamma? There we are. And I'll put it up next to delta because they're related. Basically, what happens is when the, oh, yeah, there it is right there. When the price changes, remember, delta is how much the premium will change. But when the price changes, delta changes too. Gamma is how much delta will change. So if you hear of gamma squeeze or gamma play, that's what they're referring to. You're playing for the movement in price of the premium versus the underlying and the acceleration factor of that. It's kind of like the pressure on the pedal when you're driving. That's what gamma does. You know, the pedal going down will increase your speed. And that's your delta. The speed is your delta, is changing. But the pressure on that pedal is your gamma. More pressure, more speed change. And that's what's happening here. So if we have a gamma, let's say, again, that 442, we have the gamma of about 14 cents, we'll call it. That's on the zero DTE. Going out to an option that expires a little bit later, the gamma, let's see, what do we have there? Yeah, it's a big difference. Look, 14 cents So it's 0.14. Here it's 0.017. So when it comes to the gamma of an option, options that are expiring, actually, let me do it this way. Be easier to show. I'll pick an option that's not expiring for a while. Yeah, 112 days or so. That's fine. I'll use that one. Analyze, and there we are. So this is the 440 call that expires in June of this year. And this is charting the gamma. By the way, gamma is highest at the money. As you go further in the money or out of the money, then the gamma drops as well. But also, here's an interesting thing. Options that are close to expiration have higher gamma. So let's see. The white is going to be at expiration. This one will be, we'll keep the blue as current. And then this lime green will be roughly, let's see what we have there. It's not telling me the dates. I'll have to check it out. Figure it out. Oh, it's over here, actually. So now is in blue. And look at the gamma right there. Okay, remember, this option does not expire until June. And actually, I should change that to 1 day before expiration, not on the expiration. That'll look a little better. So there we go, 1 day till expiration. And look at that difference. So currently, there's a lot of time left till expiration, so the gamma is very low. On May 4th, that's the green, we're closer to expiration, but there's still 54 days left until, I'm sorry, 54? Yeah, 54 days until expiration. So there's not as much gamma. That pinkish orange, whatever it is, has 22 days till expiration, so the gamma is higher. The day before the expiration, look how high the gamma is. So options that are expiring same day will have a huge gamma, and therefore they're going to be very sensitive to price changes. And those price changes will cause massive swings in the underlying securities premium. So you got to be careful with trading those options because that increases your risk. That happens with those zero DTE options. So we can actually neutralize some of the Greeks. And that's the way I trade. I mentioned the SPX cash flow secrets. One of the things I want to do is maintain high probability and manage the risk. Basically, if we take a look at how the program is done over the years, you can see, I want to point out a few things. Okay, this was 2023 for the SPX cash flow trading. And basically what we do is every single day, I look at the SPX, the index. Okay, so let me kind of take a step back and explain what the program is all about and what I'm doing there and how I look and use zero DTE options. Basically, what I do is I teach trading as well as trade. So here I have the members area for Wealth Builders HQ. And if I go into SPX cash flow secrets, there's multiple pieces to the program. Part one is on-demand education. So you get to learn at your own pace. However you learn best, I've got some different resources for you. I've got on-demand videos. So again, as I zoom in here, you can see I've got, how to identify trends, how to find zones properly, and SPX cash flow secrets, my strategy that I use that I'm going to talk a little bit about. Oops. And there are documents too to support all of those videos. So you can watch them whenever you want to learn about what it is to trade those zero DTE options. There's also several videos, one using Tastyworks, Thinkorswim, TradeStation, all different types of programs that people might use to be able to trade these. I'm going to be adding more pretty soon as well. Then the other part is I do interact with my students. I'm available for questions. So you can see that you can send me a message if you run any problems or have any questions about the material. We also do a live Q&A session on a regular basis. But then here's the coolest part. Every day, right around 2 o'clock in the afternoon, remember I talked about that volatility and how the prices or the time value kind of gets sucked out around 2:30. What I do is I send out SMS text messages on trade ideas that I'm looking at for a zero DTE trade on the SPX. So, I send out, as you can see, a text that says, well, let me go back a day or so. Right here, I look at 15-minute zones, 5-minute zones. I give you the zones when they were created. And then I offer some ideas that I'm looking at. For instance, there was an iron condor that was going on a couple of days ago. And there was also a bull put spread available. And then I monitor the trade. And if there are any adjustments that need to be made for stops or protecting ourselves, I send those out as well. And the results have been great. You can see that, for instance, last year, we had a win rate of 86.02%. That's what it's all about, is that consistency. Now, you'll notice the wins are much larger. Sorry, the losses are much larger than the wins. That's the way it's going to be when it comes to selling options. But it's okay. And most people are taught you always want to have a high reward risk ratio. You can't do that when you sell options. What you can do, though, is get a higher probability that you're going to be right. And that's what we focus on. 2022 is the same thing. High probability. I don't have all the 2024 stats set up. So here's, last month, which finished. You can see 82% win rate for February. And the average loss, $65 versus the average win, only 42. But look at the number of wins versus losses. And these are pretty much day trades, although this is the cool thing about this. When you get into these positions, if you do not exit the position, it goes as an expiration. It doesn't count as a day trade. So you could do these types of trades with as little as $500 in a trading account. Now, that's not recommended. The reason why is you want to have a cushion in case you take a little bit of losses. But you can see that these trades, I did bull put spreads, iron condors, bear call spreads, all credit spreads, and there's the margin right there. Not once is it above $500 for one contract. Now, are the wins huge? No, of course not. They're not going to be huge wins because the probability is high and the risk is low. But it's consistently winning, and therefore it adds up. This is showing if you did one contract for each spread, and I suggested a $2,000 account. You don't need that much. Honestly, as I said before, you could really do it with $1,000. So if you did it with just a $1,000 account, you would have had a 70% rate of return. Now, just imagine if you had a $10,000 account and you did 10 contracts, right? It says $700, that'd be $7,000 profit in 1 month. And the time in the option trade is only, less than 2 hours. Yes, the spreadsheet is based on one contract for each spread. So if it's an iron condor, 1, 2, 3, 4 contracts, but one spread. It's 2 puts, 2 calls. That's all. Basically, what I'm doing here is selling options against the S&P 500. Actually, let me show you. Where is it here? This is my chart that I'm using for the S&P. Yeah, I do take a lot of these trades. Absolutely. I don't get to take all of them just because I usually put out the text first and then I go to my account and if I have time to put it in and the pricing's still good, I can. But if the prices have moved, then obviously I don't get it. I prioritize the students first. That way I won't get in trouble for front running either. I got to make sure everything's on the up and up. So, I'm basically using this chart and identifying opportunities to sell where I think prices are not going to go. And here's the reason why I do that. Okay, if we go into the sell side, there's only 2 types of options and only 2 things you could do, right? You can either buy a call or sell a call, buy a put or sell a put. Now you can combine them, but that's it. That's all you can do. Buy calls, buy puts. And actually what I'm looking for, hang on, I'm on the wrong page here. And that's not where I wanted to be. Where are you? Right here. So this is what I'm talking about. If you buy a call, if you think markets are going up and you buy a call, you only make money if prices go up. And they have to go up fast enough that you can take the profits and it covers your cost. If you sell options, in this case, we could sell a put. That's also a bullish strategy. Actually, we could sell a bull put spread. By doing that, we would profit if prices go up or sideways or down. So we have three different ways of making a profit by selling puts, only one way if we buy calls, right? To me, I think three is better than one. I'm going to go with that. So what we're doing is going back to those Greeks, we're going to neutralize risk. As I was saying, if you're bullish on an underlying security, you go out and buy a call. What kind of risk would you have if you simply buy a call? Well, you're going to have risk from the delta, right? So we have positive delta right here. And we see we make 59 cents on the premium for every $1 that the index or stock goes up. If the stock or index goes down, we lose 59 cents. So we have positive delta. We have risk on directional movement. We have time decay. Not as much, it's only 14 cents, but every day we lose money just because time passed. And we have volatility risk, which could be greater than the delta. Even though it shows 0.58, it's a lower number than 0.59, it's actually a greater risk because the volatility will move faster than price. Well, instead, what we can do is create positive versus negative and neutralize some of the Greeks. We remove some of that risk. It's pretty neat. So we could do a bull put spread. And that's what I had on the chart from the other day. It was a bull put spread. As a matter of fact, I think it was yesterday on the 7th, where, let's see, didn't I have that here? Yeah, there was. Sold the 5140, 5145 puts. And I think it was actually shown. Nope, wrong page. Right here. Yeah, yesterday, right there. Oops, wrong one. A bull put spread is available. Selling 5140, 5145 is currently 45 cents premium and 87% probability of profit. Okay, and actually it was an even higher probability of profit, and I'll explain why in a moment. Okay, oops. Come on, zoom out. There we go. So what we did to reduce that risk was a bull put spread. Buy that call. I'm sorry, not that call. We're going to buy a put and sell a put. And the reason why I do that now, take a look at the Greeks and what's happened here. Instead of simply buying a 500 strike call, I sell the 500 strike put and buy the 495 put. We take a look at what's going on here with the Greeks. Okay. The Vega, or actually, no, sorry, which one are we looking at first? Delta. The delta of the call option would have been 58.73. Now we've dropped it down to 9.62. Okay, the reason why this line is here is we took this and multiplied by one contract. So instead of 59 cents, it's actually 58 cents, technically 0.5873. That's all. So all these numbers up here getting multiplied by 100 is a little more accurate there. So the delta of buying the call, again, our risk, if prices were to go down, is 58.73. On the bottom now, we only have risk of 9.62. So we dropped the risk from almost 60 to under 10. That's huge. The next one, time decay. Okay. On paper, you sold a bear call spread. Oh, okay. Well, as long as you sold it high enough, then you were fine if prices didn't go up beyond that. But anyway, time decay, look at that. We went from 13.86 to almost no time decay at all. That's crazy. And the volatility went from 0.57, I'm sorry, 57, 0.58 earlier, to 450. So what we did by doing this trade is a couple things. One, we reduced our risk on direction, but we also did reduce our reward. You cannot reduce risk without reducing reward. They go together, okay? The time decay and the volatility risk were almost eliminated. That's why I do these types of spreads. Now, I'm a little different than most zero DTE traders. Most zero DTE traders will do this and, they're reducing risk, which is great, but they're looking at the markets and maybe they're looking at things like, I don't know, the standard deviations. What I do is I look at what's called supply and demand. And I also look at trend. So for instance, on a day like today, actually, again, let's go back to the ones that completed. So yesterday, right around 2 o'clock in the afternoon, There we are, 2 o'clock in the afternoon. I'm looking at my chart and I see a few things. Okay, one, first of all, it's on a 15-minute chart, not a 5. But I do both. I do multiple time frame analysis with this. And see, there it is. Looking at selling the puts just below that zone. There are other zones that are available as well. But basically, if I think prices are not going to go below a certain level, I can sell options below that level. And that's exactly what I was looking to do there. I can also, like I said, look at the upper side. And I believe I did have, yep, right there. There's an iron condor available at that time as well. For some reason, it cut off the iron condor on this. It's actually on my phone. And it went out to all the students as well. Let's see here. Where was it? Trying to find it now. It was SPX. There we go. Iron Condor 51.35 to 51.40, and then 51.85 to 90. And that was offering 80% probability of profit at 40 cents. So again, going back to our chart, the upper side of that was 51.85 to 90. And the reason why I selected that, as you can see, there was actually a Fibonacci extension above that area, 51.83.62 right there. So I was anticipating that prices were not likely to go above that area or below this area. It's 51.85 to 90. Come on. The nice thing about doing the iron condor is that you increase your return without having to increase your risk. You know, you can't lose on both sides. You can only lose on one, not the other. So for instance, we look at what's going on today. Okay, now this is not a recommendation. I'm just doing a quick peek at what's happening here in the markets. And what I'm noticing is, well, it looks like we've got possibly some selling pressure above. Let's take a look at a smaller time frame. A 5-minute. There we go. And this demand zone obviously has been broken, so I'm going to get rid of that. But I definitely have supply. And maybe you have one here. A little drop-based drop. And let's see. Move that guy back over. We've got a supply from today at 11:05. And another supply here, 10:35. So if I believe that prices are not going to go above that supply, we'll call it 51.70. And if I can find a good demand zone, well, everything's been tested already. So not sure if I'd use this or not. Again, I got to do more research, look at the trends and everything else. I'm just doing a quick search. But here's the thing. If I know that prices are not likely to go above that supply, I could just say, okay, I'm going to go ahead and do a credit call spread where I don't believe prices will go above, I said 51.70. So I'll sell, oops, wrong security, SPX. Zero DTE. And we're going to go ahead and sell 51.70 and buy 51.75. And you'll notice right here, and I don't really care too much about the chart. It does show the probability of profit is pretty high, about 78%. Remember, it's probably higher because we have supply that I'm actually using. That's what makes a big difference with my service and what I'm doing with my trading. And the reason why I have such a high win rate is because I'm adding on trend and supply and demand to find institutional trading that's going to support what we're doing. So even this, right now, we can use $435 to make 65. So what kind of return are we looking at? Now, I wouldn't do it this early in the day. Once again, I usually do it about 2 o'clock. It's not too far off, but 65 divided by 435, that would be a 15% rate of return in 2 hours. That's pretty darn good. And that's just one contract. Obviously, if I go ahead and multiply that by, say, 10, now it's five, well, it would have been 600. There it is for $4,400. Same rate of return. It's just a different number of contracts. Now, let's just go with one contract right here, 440 to make 60. Why wouldn't I want to get a better return using the same amount of premium? If I know where we're going to top out, what if I also find somewhere we're going to bottom out? So maybe 40, 50, 90. And we go back to neutral. And instead of just the upper area where, again, I was selling the call at 51.75, 51.70, I would also, I just forgot the level, 50.90. And 50.85. Let's see how that works. So now what I've done is I've increased, it's not a whole lot more, but instead of 60, now I've got an extra 10 bucks of profit. Oh, maybe even closer to 25, I'm sorry, 15 bucks extra. And I'm still using about the same amount of margin. Would I look at old supply and demand zones at 2 p.m.? Yeah. I mean, I use zones as long as they haven't been tested. If they've been tested, then no, I'm not going to use them. But yeah, I will look at my zones, and you can see I've got zones set up here going back months. It's because they haven't been used yet. And of course, I mentioned I'll look at trends and strength of the trend. So my point is, though, by using the iron condor, I get to use roughly the same amount of margin, but I gain more premium by doing that. So if I was only doing the calls, it was $435 margin to make 60 bucks. Now I can make 70, 75 bucks with $430. So I definitely make more using the iron condor, but it has to be available based on the trend. So I'd rather do both legs and create an iron condor versus just doing a bull call spread or bull put spread or bear call spread. They're both credit spreads. And it's nice, with this program, which is pretty cool. This is Options AI. I can actually do everything visually and see based on where I think prices are going to go. They even have what is called the expected move, as you can see, kind of give me an idea of where we're likely to end up for the day. Now, it's not guaranteed, but that gives you an idea based on volatility. So I'm neutralizing risk, increasing probability, and by doing this type of trading using zero DTE, I've eliminated overnight risk. I don't have to worry. I sleep well at night. I don't have any open positions. I have to worry about the market crashing or about some tweets going out or, the Jerome Powell saying, yeah, maybe we won't be cutting rates for a while. Or this morning as the margins expanded, last night the margins were increased quite a bit. Why? Non-farm payroll news came out this morning at 8:30 in the morning. Now, if you're an options trader, you just got to sit back and hope for the best because you can't do anything until 9:30 in the morning. I do sleep pretty well. Yeah. So then that's the part of it. I find high probability opportunities and increase those opportunities by knowing how to identify the better places where prices are not going to go. So when it comes down to kind of recapping here with the zero DTE options, again, zero DTE options are nothing more than options that happen to expire on the same day as you're trading them. So going into Option Station Pro, again, if I look at a list of options, all of these will eventually become zero DTE, but the only one that truly is today is the ones that expire today. Zero DTE. And you can see it on any interface. It could be trade stations, or as I showed you, this options AI, where I can go ahead and click, okay, we expired today. Now I choose the SPX options. Another reason for doing that is I want to also reduce my risk. So let me do this. Bring up a Word document, just a blank one. If I can. Where the heck? Oh, I don't have it here open right now. That's okay. But basically, zero DTE options. Kind of a review of what we've been going over here today. And of course, if you have any questions about it and you want to learn more, let me know. As I mentioned, I have the SPX Cash Flow Secrets program, and you can try it out absolutely free for 2 weeks. We don't actually bill you for the first 2 weeks if you do the quarterly enrollment. Oh, there we go. Lee and I both posted at the same time. So a 0 DTE option is an option traded on the day of expiration. Oops. That's all it is. And I want to trade it with higher probability. So selling options, credit spreads, oops, then debit. So we're basically selling options, credit spreads. If you want to get gutsy, you can do an iron butterfly too. Offer higher probabilities than debits usually do. Now, to also increase probability, is supply and demand. Oops. I'm working my grammar here. I also increase probabilities by using those. Should I say trade on the same day as expiration? Is an option traded on the same day of, or day of expiration? It's the same. As long as you're trading on this on the day of expiration. And like I said, by increasing our probabilities, I do it in multiple ways, also avoiding pattern day trading by allowing the options to expire. Whoops. Okay. Basically, we avoid that pattern day trading. We don't need to have $25,000 in a trading account like you would for stock trading, because if you open a position and never close it, it's not a day trade. You have to physically buy and sell the same day, or sell and buy the same day of the same security. We allow these to expire. I usually choose SPX options. Basically, they are index options. Because they're European. That means there's no early exercise. Okay. Now, stops that are triggered would be counted as a day trade. Yes, absolutely. If you have a stop loss that's triggered, it is a day trade. And I do use stop losses on these as well. And if you also get out at a profit target, a lot of times brokers will allow you to close your positions for a nickel premium without charging you a commission. That will count as a day trade if you close it out. So be careful of that. But I choose index options because they're European options, which means you cannot exercise those options early. So as a seller, you reduce or eliminate, in this case, early exercise risk or assignment risk. The only way you get assigned is after the market is closed, and index options are cash settled. And that can also be important. Okay. How do you set a stop? You asked Thinkorswim, they said it's not possible. Absolutely, you can. They just don't know how. I can show you right this moment. As a matter of fact, I have a video on it. Remember what I said before. If you go into the program, where is it? Oh, I'm on the wrong page. It's right here. If you go in the educational videos, setting stop losses based on strike price And right here, you're trading using Thinkorswim, trading using Tastyworks. I actually have videos on how to do it. It's built in here. So yeah, don't let them tell you can't do it. They just didn't want to deal with it. So you can actually place stop losses. Right here, I'm going to mute that down, and let's see here if I can find it quickly. This is placing the order. And once you're in the trade, that's when you set it. So right there, I'm actually doing it. So this was an option that we sold, or spread that we sold right here. It looks like it's sell the 45.40, 45.35. It's a bull put spread. I spent 45 minutes with her. Well, I can spend 5 minutes with you to show you on toss. So right there, that's the entry to get in. So we're getting a credit. And then what happens is once we're in the trade, I think, where is it here? Like I said, a whole video on it. Yeah, I went into the trade and did the inverse right there. And what I'll do is I'll change that from a limit order to a market order. And you can do it as a stop limit or stop market order, I think, too. No, that's what I did. I just stop market. And what I did is I set that at 3 times the amount of premium I was collecting. And that's it. So if the prices go against me and it gets to be 3 times, it's a stop market order. It'll automatically trigger and get you out. So I don't know what they're talking about that you can't do it. You just do the inverse order and put in the stop market. Or the other thing you could do is if you wanted to deal with, let me show you here. I mean, I don't know if I just happen to know more about the programs that they do, but anyway, where is it here? Oops. Toss. Come on. There it goes. There's a couple different ways of doing it, to be honest with you. You could put in a market order for the inverse of the option, and you could put in a condition on it. And it would get you out of both. Yeah, it would get you out of both legs because you're doing the inverse of the one that got you in. So yeah, absolutely, you put in the stops. And like I said, the video shows you how to do it step by step. So for instance, here, if I go in, oops, I typed that in wrong. But yes, it is possible. Simple answer. So, I've been doing this for many, many years. I've been trading on it and trading with Thinkorswim for at least 8 years, 9 years doing this, even though, I've only been doing it as a Wealth Builders HQ program for a little over 3 years. I've been doing this type of trading for a long period of time. So yeah, if I go into trade, let's do a quick simulated account. And again, it's loading a little slow. Apologies. Again, I got a lot of things running on my computer right now. So if I go to SPX, there we go. You can do it with any option, really. Come on, S&P 500. 0 DTE. Didn't go. Did it? Oh, yeah, it did. So that's a vertical spread. Let's say I do a bull put spread. Where are we sitting right now? About 51.30. Let's do this one just for the heck of it. I'll sell that. And what I do is one. Let's do market to get in, confirm and send. There. See, did it go? Yep, now I'm in. Okay, so I got in right there on that spread. And now, let's see. Can I do the inverse? Trade closing order. Nope, it's only doing one, isn't it? Nope, there it is, vertical. So there's the inverse, right? And again, I got in on, what did I get on that? I didn't even look. Oh, it's filled at 150. Okay, so I got filled at 150. So let's say I want to get out if it goes above $3. Okay, right here. Stop. If we go above $3, that should be it for the day order. And as long as it doesn't go above that, I shouldn't get out. But this is the inverse. I shorted the 51.20, bought the 51.15. So now I'm doing the opposite, buying the 51.20, selling the 51.15 on the spread. Where do I see probability of profit? Yeah, it's different on toss. It would be under the analyze probability analysis right there. That's how you do it. So you got to go through the probability analysis and use this little cursor. It's not as easy as it is on Tasty and other programs. But yeah, if I go back, oh, Schwab, yeah, that may be another problem as well. They're doing the changeover, but this should work if I do this confirm and send. And again, go to my monitor, and my orders placed have not been triggered right here. Working orders. So as long as the premium stays below 3, I'm still in the position. If it goes above 3, then I get out. Now, here's the other cool thing. Let's say I want to set a stop, not based on the premium, but based on prices of the underlying. Watch this. If I do that, let me see, where was it here? Analyze closing order or create closing order. I could do that too. Instead, I just change this to a market now. And let's say I want to get out. I will exit if the index drops equal to or lower than, let's say, 5120. Or if it goes above, let's say 5150. There we go. So now I've put in a stop that will automatically leave me out if prices either hit a target or hit my break the demand zone. Yeah, you can set all those stop orders. It's really easy to do. You just got to know what you're doing. That's all. So yeah, I've got those. If I go to monitor, there they are. They're all ready to go. And that's it. So I got to get going because actually I got to get set up and get ready. This is where I start doing my analysis based on, what's this? If I start going into, this is when I start doing my analysis, as I said, for the SPX cash flow secrets. It's 2:00 is where I'll put in the trade. So I've got to get ready and start that whole process. I'll do my analysis, set out the zones for both the supply and demand, where I think the price is not going to go, as well as the opportunity that's out there. So as I mentioned before, if you're interested in joining me, love to have you in the program. You can go ahead and click on the link that we gave you, and we can give it in again. I should consult for Schwab. I'm already consulting with TradeStation, so I don't know if I have time or if I'm even able to. But yeah, you guys have a great day for trading. If you got more questions, please contact me. You can hit me up at support@wealthbuildershq.com. I'd be more than happy to help you out. If you're part of the program, obviously it's even easier to get a hold of me. Just scroll down to the bottom and send me a message if you need help. But yeah, you definitely can do a lot of those different types of orders out there. And be careful if you're not familiar with those 0 DTE trades or how to place those orders. Practice it in simulated mode or paper trading mode first. So have a great weekend, everybody. Trade safe, trade well. Take care, everyone. I'll talk to you soon, hopefully.